All right, we got the thumbs up and ready to go. I'm Michael Kopinski, the Director of Research and Media and Entertainment Analyst at Noble Capital Markets. And with me today we have Engine Gaming and Media. And so this is going to be a little bit different than the types of company presentations that we've typically had. We're going to do it in a fireside chat format. If you have a question, just raise your hand. I'll be looking up occasionally and we'll take questions from the audience. But I will lead those questions off and we'll get started now. So let's start with Tom. Can you just talk a little bit about the company, the Engine Gaming and Media, and what is it?
Very good. Well, I'm glad Engine Gaming and Media was such a big draw for your conference.
We're going to build upon that.
Engine Gaming and Media is a media tech company that is at the forefront of the convergence of gaming and media. It was formed in the midst of COVID, bringing together two publicly traded Toronto Exchange companies. One, Frankly Media, that focused on programmatic advertising in the digital advertising space, and another one called Torque Esports, which had a number of esports and gaming interests, along with a private Silicon Valley company called WinView. Leo and I didn't believe you could do a three-way merger from home in the midst of COVID, but we pulled it off. And we uplisted the company to NASDAQ about 9 months ago under the symbol GAME. Have shed a number of assets along the way that we didn't think were critical. And now we are most focused on the elements of gaming and media where it comes to social influencer marketing and how you target marketing and target programming, where gaming and media meet, and the creative economy, creator economy, user-generated content, which has become an enormously important area for audience, and how media companies target that space economically, how they vet influencers in that space, how it's measured across both live streaming platforms. You've probably heard of Twitch, Facebook Gaming, YouTube Gaming, and many international live streaming platforms that gamers and other forms of content are streamed at on an enormous audience basis. And the social media influencer world across TikTok, across Instagram, across all the social media outlets, being able to measure the impact of influencers, being able to vet them, being able to help them implement social commerce programs, increasingly an important part of the digital marketing economy, social influencers driving to commerce, e-commerce activity. So we are a company that specializes in the data, analytics, and feasibility for marketers to be able to drive that while driving our own programmatic advertising on behalf of a number of media companies that range from Newsweek to legacy television and radio stations. And the combined expertise we have in programmatic advertising and digital marketing, where we combine live streaming platforms and stage social media, gives us a unique differentiation in the overall media content space.
Well, it seems like there's just a big market opportunity in almost every one of those segments you talked about. And I was wondering, Lou, can you just talk a little bit about some of the key growth drivers of the business?
Yeah. So we uniquely sit on top of several macro growth trends. One is in the influencer marketing platform space. This is a 30% CAGR market, growing from $2 billion in 21 to about $5.5 billion in 25. The whole growth in esports viewing, as we know, in video gaming is a huge industry. Game publishers make a significant amount of money licensing their product, but in the last sort of 5 years, a lot of that activity has moved to these streaming platforms, whether it's Twitch or YouTube or Facebook. And the audiences that are consuming or watching other people game is continuing to grow. 800 million people is the TAM for audiences that are consuming streaming content on those live platforms, and that's going to grow, to about 1.5 billion by 2025, another 15 to 18% sort of CAGR opportunity. And then the last one is really digital advertising. We all know how big digital advertising is, $200 billion market, last year, growing to about 350, another $15 billion or 15% CAGR market. So I would say those when you break that down, I said there's two big themes. One is, programmatic advertising. A number of large media publishers entrust Engine with their digital ad inventory. Companies such as Newsweek, in the radio space, Cumulus, and 500 radio stations. So we touch about 1,200 different media publishers that rely on us to help them monetize their digital ad inventory.
Yep.
I'll pause.
Yeah, until that was just an exclamation point behind your comments. Does everybody understand social media influencing and that sort of thing? Do you know what they're talking about? Yeah. Does everybody else over here? I mean, do you want to explain a little bit? Can you give an example about influencer marketing? I mean, I would like to be an influencer and get paid, but I was wondering if you can just talk a little bit about what that means.
Well, influencers exist in both the gaming world, which we have one company which is considered the Nielsen of gaming called Stream Hatchet. And you have, as Lou said, gamers playing, esports contests playing, people involved in the gaming industry posting content. And these people who are active on these platforms, as I'm sure you've seen on the social media side as well, on Instagram and TikTok, where people who have an audience following, therefore called influencers, they are often providing marketing commentary for a product or service. And this has grown to be a very important part of the digital marketing advertising economy because of the credibility and the intimacy that these influencers tend to have with their audiences, individuals who create their own content, who with that provide a basis for people to relate to them in an area they're interested in. Some of them have millions of followings, some of them have hundreds of followings. And because there are so many influencers out there, for media sponsors, brands, to navigate that world, to know where the audiences are that they care about, to measure the size of those audiences, to be able to vet the safety of the content that those influencers are involved with, to be able to onboard them in a way that's consistent with their practices, to understand how to monetize them, to how to drive customers from an influencer to a site where commerce can take place. All of that requires an enormous amount of platform flexibility that we provide, and measurement, analytics, data, in order for that huge capturing of audience that these influencers do, melding it with the media companies who are now, or brand companies that are now understanding how important reaching that audience is. So we do that in the gaming side, we do that in the social media side, and then the programmatic advertising that we do actually has us as the sellers of inventory of mostly legacy media companies who knew the traditional advertising world very well. But programmatic advertising is a whole different thing. Programmatic advertising is where digital inventory is matched with data about an audience on the fly to make sure that the audience and the inventory are put together in the most efficient way for the seller of the advertising and the brand looking for that audience. And so we actually do that, and by virtue of doing that, have a very sophisticated understanding of the digital advertising marketplace. So then when we are advising brands about how to place their marketing campaigns in this digital world, as an actual seller of advertising when it comes to these other businesses in gaming and social media influence, we have an even better expertise to be able to guide them. So that's the combination of our businesses.
Yeah, and I was wondering if you could just expand upon that a little bit. I mean, what separates your assets from what looks like a crowded field? You touched on it in your explanation, but I was wondering if you can just dive into that a little bit more.
Well, there are a number of things. One is that combined expertise in actually selling programmatic advertising while being able to guide marketing campaigns of advertisers who are looking for the best way to execute a campaign beyond the actual sale of inventory from the media company side. So we represent brands in guiding them, represent sellers of media inventory on the other hand. That is a combined expertise. Another combination is this idea that social influencers exist both in these streaming platforms where gaming and other content goes on, as well as the social media world of TikTok and Instagram, Facebook. And we are unique in our ability to guide across that entire span of where people go for live streaming, as well as where they go for in the static social media world. Being able to show where somebody who's live streaming where their social media interests lie and vice versa is a unique expertise as well. You put that together with the fact that we are very much focused on how to make sure that a SaaS business has developed here, so we are not just selling on the basis of the strength of our advertising revenue, but have also developed a SaaS-based business with the unique characteristics that SaaS businesses have in growing in this fast emerging market that the CAGRs that Lou mentioned speak for themselves.
And Lou, you recently announced the reduction of your emphasis on your direct-to-consumer businesses, and I was wondering if you can explain your thought process on that decision and what that really means.
Yeah, so in our most recent earnings announcement, I think we highlighted the fact that we were going to reduce the spend against our direct-to-consumer platforms as a way to control cash and as a way to be more prudent in our cash spend sort of going forward. But more importantly, our goal is to reach cash flow sort of break even sort of in the near term. So it made much more sense for us to be a little bit more selective in the way that we spent our cash and allocating our cash against our B2B SaaS businesses. Given the unique sort of opportunity that we have individually in some of the platforms, but also in the aggregate, when you stitch together some of these platforms and assets that we have within our portfolio. Tom mentioned Stream Hatchet or Sidekick in the influencer marketing space. We have a really unique opportunity to take advantage of this groundswell around advertisers and CPG and performance marketers that look at influencers, as a path to drive sort of higher conversion. And B2B has higher degrees of predictability. We believe we have a unique position to take advantage of this market opportunity. And from a cash spend perspective, acquiring customers direct to consumer for our owned and operated properties was an expensive proposition. Given how overcapitalized some of the companies that are pursuing similar types of consumers, how expensive it was to acquire those customers.
Mm-hmm. And I was just wondering, can you give a little bit more detail or an overview of how you get to cash flow break even and what your thoughts are looking beyond that?
Well, when you marry some of the cost reduction initiatives, particularly around marketing, obviously, in technology, companies such as us, personnel costs are significant. So, reducing sort of personnel, reducing sort of marketing spend, and shifting sort of the focus, to B2B, where we have a very sort of unique position in appealing to game publishers, which is a big, high growth market, agencies, brands, other enterprise organizations, that are benefiting from our technology. And based on our historical, growth figures, we've been able to demonstrate, 40+% sort of year-over-year growth in our programmatic advertising space. And in our most recently reported quarter, 25% sort of year-over-year growth in SaaS. So through more concentrated spend against our B2B business, growing sort of our top line, reducing some of the marketing expense on our direct-to-consumer businesses, we feel confident we can reach or break even next year.
Okay. Tom, obviously embedded in your D2C business, you had WinView, and then in WinView, it had a really interesting lawsuit, and so I was just wondering if you could talk a little bit about the status of the patent cases that you have against DraftKings and FanDuel, and what your emphasis now on your B2C businesses might, do to those in relation to that lawsuit.
Well, in addition to the data and analytics, SaaS and advertising business we have a very substantial patent portfolio, about 80 patents, 1,200 patent claims, highly focused on the gaming business. A number of them read very heavily on sports gambling. Sports gambling is an area that is fraught with issues related to latency, how quickly one person who may be betting in the instant, in the moment on a sporting event, sees that event relative to somebody else on a different delivery system, as broadcast, cable, streaming all have different times of event delivery to the person's device. And we have patents that deal with that and a number of other areas. We've sued DraftKings and FanDuel on 4 of those patents. I should say I was CEO of TiVo for over a decade. We had quite an extensive patent portfolio. That patent portfolio was able to generate for us close to $2 billion in revenues and royalties, and the same enforcement team that I used at TiVo is representing us here. The litigation's in early stages. Patent litigation doesn't get resolved quickly, but we obviously think that those patents have substantial value.
And I was just wondering, Lou, we turn it back to you. Obviously, we've seen a lagging stock price. I was just wondering if you could just kind of talk a little bit about what your thoughts are of why the stock price has lagged here recently.
Yeah, I could start, and I know, Tom, you have a view on this as well. I think, we're all sort of disappointed about sort of the stock price. I think, in the small cap, sort of micro cap space, I think we've seen a disproportionate amount of punishment, from stock price declines, and I think that's probably sort of a combination of things. I think, the Fed's, movement on interest rates, has created sort of a more of a risk-off, type of investment, philosophy right now. Small cap companies are high growth, require a lot of front end or forward investment, and as the risk tolerance is reduced, we've become much more mindful, right, of the investments that we're making, and to our earlier point, we're reducing sort of our sort of burn rate to be self-sufficient, cash generative, and not burning money, to address some of the investor sort of concerns around sort of small cap companies. But I think it's there's clearly a headwind around small cap companies. I think it will change at some point, but we need sort of to change the narrative, by operating sort of against the current currents.
Mm-hmm.
Let me chime in a little and expand on that. I founded CNBC, as you know, and I'm still a CNBC contributor. I was on Fast Money yesterday talking about what happened to Netflix, talking about stocks taking a dive. But let's just put in context a little bit our stock history. When we uplisted to NASDAQ, I think we were trading initially at about $14 a share. Things were going well. Bankers advised us to bake on the exchange for a few months before doing an offering, which we wanted to get off. And over the course of those 3 months, sentiment began to change pretty drastically, that instead of top-line revenue growth and how much you invested getting that growth, which was how an awful lot of companies were being invested in the tech media sectors, sentiment drastically changed to you better not be cash flow negative. We're very focused on companies getting to cash flow break even. And we were a long way from cash flow break even and hadn't gotten off an offering. And our stock, with a whole bunch of others, I just mentioned DraftKings, that is just another example of companies that took a huge slide. Today, we find ourselves with a $21 million market cap, I believe, having pulled off a transaction that approximately $16 million on a non-dilutive basis, selling Eden Games, one of our non-strategic assets. So we are trading at $1.40, I think, right now, maybe a little below that. So we're trading as a very distressed company that isn't distressed. We actually thought we should get a lot of credit for selling an asset for $16 million, showing that we had cash we needed for the foreseeable future. And the stock, for whatever reasons, as Lou was pointing to in terms of macro conditions, continued to decline. Now think about that, a transaction that with the balance sheet fortitude that gave us, and a $21 million market cap with a company last year that for the calendar year 21, I believe we did just under $50 million in revenue, excluding the sale of Eden, so it's not totally apples to apples. The first 6 months of this year we did over $21 million, growing overall revenues at 20% and our SaaS revenues at 25%. Having gotten our expense base way down as a result of the overlaying notion in the market that driving to cash flow break even is essential. So you put all those factors together and we're kind of shaking our head, not quite understanding where we are in the market, but as Lou said, continuing to drive growth the way that we are, continuing to reduce expenses the way we are, continuing to have not only an operating business with the kind of macro tailwinds we have, but some hidden jewels like the patent enforcement actions, and put all that together, and we think we got a lot of upside life in our stock.
Well, you certainly have done what I would consider to be shareholder-friendly moves. I mean, you could have done a very dilutive, equity offering or something of that nature, and and of course you didn't do that. Why did you sell Eden Games then?
So we sold. If you read sort of recent press release, we sold Eden Games and closed on it a couple of weeks ago. And Eden Games was our game development subsidiary. Is based in Lyon, France. Eden Games was a mobile gaming development company. They were an outsourced provider building games for others such as Formula One and other sort of, with a high degree of emphasis on motorsports racing. The reason we sold it was we knew that the way to really grow the asset was to build the direct-to-consumer streams of revenue against our intellectual property. It made up a small percentage. Most of the revenue we generated from Eden was work for hire, and it required a substantial sort of investment or partnership. When we went out and we ran a strategic process, hired a bank, met with 50 to 60 different game publishers in the space. What we had hoped to achieve was finding a strategic partner that can help invest and support the distribution of a direct-to-consumer business. What we've discovered is the interest was really to acquire sort of the asset. And when we sort of compared and contrasted the options of, as you pointed out, Mike, raising capital or selling sort of Eden, selling Eden on a non-dilutive basis was a far more attractive way for us to generate the type of cash that we needed in order to fund our near-term operations and at the same time sort of reduce any dilution to shareholders.
Everybody's heard about the metaverse, and we're going to have a role in that because we have the measurement tools and assessment to be able to guide people through where influencers particularly will be in that world, who will probably be some of the earliest adopters of the metaverse. But being a gaming studio trying to build the sophistication of the metaverse, we knew was going to be a very capital intensive thing, which is really the next stage for these kind of interactive games. And that kind of capital intensivity, when we decided it was not a core pursuit relative to the cash it could generate to fund our core businesses and put us in a position, as you said, to do something non-dilutive to shareholders, we think immensely strengthened the company.
We have time for a quick question in the audience. Go ahead.
Could you describe exactly how programmatic advertising works?
Programmatic advertising? Well, Lou, go ahead.
So we know traditional advertising, right? It started in radio and television where you buy commercials. Programmatic is an auction environment where the buyers, right, which are typically the advertisers or the agencies, are finding and advertisement placement on an automated basis based on it's no different than stock market. Here's a price. The suppliers are the publishers, or so it's basically an auction market for advertising.
Done on what are called sell-side platforms, exchanges, which are the matching entities between where the inventory exists and the data about the audience they're looking for, and that electronic match is done on the fly, so you're able to insert an ad to immediately capture who is online or in a mobile environment, who is in front of the content that you want the advertising to appear in. So the actual combination of audience with data is done without human intervention. There is a sales team that kind of puts in place the mechanics to do that, but the actual match occurs mechanically.
And with that, we have to wrap up. And we're getting the sign. All right, thank you, everyone. Thank you.
Thanks,
I appreciate it.
Yeah.